Welcome to the Deep Dive, the show where we distill complex sources, investment memos, market reports, proprietary research into clear, actionable knowledge for you.
Today, we are focusing on a company that you probably interact with dozens of times a week without even realizing it. It's a crucial, yet often overlooked gear in the massive machine of consumer staples.
That's right, we're talking about Coca-Cola Consolidated. The ticker is COKE, traded on the NASDAQ.
And when most people think of Coca-Cola, they're thinking of KO, the big parent company, the brand owner that sells the concentrate.
But Coke is the operational engine. They're the ones on the ground.
Exactly. They are the largest independent bottler in the U.S. They take that famous syrup, they bottle it, they can it, mix it, and then they sell and deliver it across 14 states and Washington, D.C.
That's a huge territory. We're talking about serving a population base of roughly 60 million people.
It's a colossal logistical operation. I mean, this is a business that generated $6.9 billion in net sales in 2024. So our mission today is to really evaluate this deeply entrenched cash-generative machine. The core question is this. Does Coke, a company anchored by probably the most resilient consumer brand in history, represent a sound long-term investment?
Especially for an investor who's looking for stability, consistent cash flow, and, moderate growth.
Right. And to answer that, we have to look far beyond just the familiar red can.
We really do. We need to scrutinize three key things. First, its century-long evolution, how it got to be this big.
Then its recent operational efficiency. How well are they running the business today?
And most crucially, we have to talk about the implications of its major strategic pivot, that late 2025 buyout of the Coca-Cola Company's minority stake.
A move that, it just fundamentally altered its balance sheet and its governance. So let's start at the beginning. Let's unpack this history.
Okay, so to really get a handle on the resilience of Coke, we have to go way back. Where do we start?
We have to start at its origins in 1902. A man named J.B. Harrison secured the initial franchise rights in the Carolinas. And you have to picture this. It wasn't some big national corporate venture.
No, this was a local, boots-on-the-ground operation built on, grit.
Exactly. And the early logistics really paint a picture of what the bottling business was all about back then.
We are talking about horse-drawn carriages, right?
Horse-drawn carriages, hand-washing every single bottle. It was all about intense local market knowledge. This wasn't just about distribution. It was about deep regional entrenchment.
And that foundation seems to be a core part of their identity even today.
It is. That era established the twin pillars of family ownership and local market dominance. They survived the Great Depression, they survived 2 world wars by focusing intensely on their defined geography.
So that deep, multi-generational regional presence is a core legacy strength that still gives them a competitive edge.
Without a doubt. But, regional entrenchment is fantastic for stability, but by the 1970s, it wasn't enough to fund ambitious growth.
Right, they needed capital. And that need for capital led to the first major inflection point for the company.
That was the decision to go public in 1972. They were initially called Coca-Cola Bottling Company of Mid-Carolinas.
And the IPO wasn't about cashing out. It was purely a capital-raising mechanism, right?
Purely. It was to fuel their signature strategy, which was aggressive, contiguous M&A. They started buying up neighboring franchises, Greensboro, Raleigh, Winston-Salem.
So they were expanding their exclusive territory block by block.
That's exactly how they did it, which eventually led to the name change we know today, Consolidated back in 1980.
And that M&A strategy, it really hit hyperdrive in the 1980s.
Oh, absolutely. Under Chairman J. Frank Harrison Jr. and CEO Marvin Griffin, they just doubled down on the idea that scale was the ultimate defense in the so-called bottling wars.
And there was one deal in particular that really defined this era.
A huge, defining move. The most significant deal was the $300 million purchase of Wametco Coca-Cola in 1985.
$300 million in 1985 dollars. That's a massive bet.
It was transformative. That single acquisition doubled the size of the business and added territories in Alabama, Tennessee, and Virginia. It instantly vaulted, Consolidated to the number 2 bottler in the entire U.S.
Okay, so here's where it gets really interesting, because almost immediately after reaching this incredible scale pinnacle in 1985, they were hit by an external shockwave that nearly cratered the entire industry.
The new Coke disaster.
The new Coke disaster. This is a perfect illustration of the immense, almost existential risk that's inherent in that bottler-supplier relationship.
It is. When the Coca-Cola Company, the brand owner in Atlanta, decided to unilaterally change the 99-year-old flagship formula, the bottlers, well, they were legally obligated to roll it out.
They had no say in the matter. Despite all their manufacturing assets and logistical prowess, they had zero strategic defense against a massive error coming from headquarters.
And the market reaction was, as we all know, immediate and absolutely devastating. Sales just plunged.
So bottlers across the country saw profit erosion, and for Consolidated, which was already leveraged from that huge Wometco deal.
The losses were significant enough that it contributed to leadership changes. It ultimately led to CEO Marvin Griffin's departure in 1987.
But that crisis, as painful as it was, it must have served as a huge cautionary lesson for management.
A crucial internalized lesson. It reinforced the non-negotiable power of the classic Coke brand and the absolute necessity of aligning your operational execution with what consumers actually want.
Something the parent company, ironically, completely failed to do.
Right. And yet, despite that major setback, the M&A strategy continued. They just kept expanding contiguously, absorbing bottlers in West Virginia and other areas, steadily securing their dominance.
So by 1991, they were back on track.
They were. By 1991, annual sales surpassed $600 million.
So following that mid-'80s turbulence, the leadership stabilized under James L. Moore, and the focus shifted. It went from just sheer acquisition volume to
What?
operational quality.
Exactly, and technological refinement. This was the essential modernization phase that really laid the groundwork for the efficiency we see today.
So what did that look like on the ground?
They invested heavily in advanced IT systems for logistics and for real-time sales tracking. I mean, think about equipping every single route driver with early handheld devices to manage inventory, track sales, and optimize their routes on the fly.
This wasn't the sexy part of the business, but it was absolutely essential.
It was critical. It ensured that every bottle sold in their territory was tracked and delivered as efficiently as humanly possible at the time.
And strategically, they also cemented their regional control. There was a big joint venture in 1993, the Piedmont JV with KO.
Exactly. That JV was a landmark agreement. It effectively gave Consolidated control of over 90% of the Carolinas territory.
So it was a model for future expansion.
A highly effective one. It led to sales and operating cash flow nearly doubling in the 5 years right after that shakeup. It proved that working closely with the supplier, but maintaining operating control, was the key to maximizing local profitability.
And this whole time, throughout all this expansion and modernization, one thing remained constant. The Harrison family maintained absolute strategic control.
That is the critical governance note here. They held approximately 86% of the voting power through these super voting Class B shares.
And that insulation from quarterly market pressures allowed them to make these long-term capital-intensive investments.
Yes, things like the IT systems and the distribution centers without having to worry about activist investors. It ensured stability and a real long-term focus.
That stability continued into 1996, when J. Frank Harrison III, the fourth-generation leader, took the CEO mantle. And his management style was pretty steady right until the next great inflection point that really defined the modern company.
The refranchising era.
Right, the 2010s.
The 2010s were completely transformative. The parent company, KO, decided that they no longer wanted the asset-heavy, capital-intensive bottling business on their balance sheet.
So they started selling off all their company-owned bottling operations in the U.S.
And Consolidated was incredibly aggressive in pursuing those territories.
They were the biggest beneficiary, weren't they?
By far. Between 2016 and 2018, they added massive new markets, including Baltimore and large swaths of the Midwest.
So this wasn't just marginal growth.
No. This boosted Consolidated's total revenue by 30 to 40% almost immediately. It solidified them as the undisputed U.S. leader among all Coke bottlers.
And that new, larger scale and efficiency was then tested by the ultimate stressor, the 2020 COVID-19 pandemic.
And this is just a fantastic example of management's operational flexibility. When all the on-premise sales, restaurants, stadiums, movie theaters, when they collapsed overnight,
demand shifted violently toward retail. Everyone was buying multi-packs at the grocery store.
Exactly. So management had to pivot production immediately from fountain syrup concentrate to finished goods in aluminum cans. They had to manage this massive supply chain shift, navigate an industry-wide aluminum shortage, and somehow they maintained stable profitability through it all.
It really validated the strength of their internal systems, many of which were seeded decades earlier.
It did. Which brings us right to the present day and the monumental move in late 2025, the strategic independence buyout.
This felt like a capstone move for the family.
It really was. In November 2025, Consolidated repurchased all 18.8 million shares held by the Coca-Cola Company.
For $2.4 billion.
An incredible sum. And this move severed a decades-long equity tie. It eliminated KO as both a shareholder and a director on their board.
So what does this all mean? I mean, for the remaining public shareholders and for the entire financial structure of the company.
It means higher risk, but it also means a higher potential reward. Financially, it was instantly EPS accretive. It reduced the share count by roughly 21%.
Which is great for existing shareholders.
It is. And it signals management's profound confidence in their future cash flows. However, the funding mechanism is key here.
Right, it was half cash.
And half new debt, including a $1.2 billion term loan. This move fundamentally removes that historical legacy of being ultra-conservative with low net debt.
So it substantially increases the company's financial risk profile due to that higher leverage.
It does. And it also further solidifies the Harrison family's strategic control over the entire enterprise.
Okay, so let's take a step back here. We've traced the history from horse-drawn carriages to this multi-billion-dollar logistics giant. The key legacy strength seems clear. Formidable market power built on multi-generational relationships and incredibly efficient distribution assets.
Absolutely. The investments they made back in the 1990s, those early IT systems for logistics, have evolved into today's cutting-edge route optimization and data-driven demand forecasting tools.
So they have an efficient, integrated asset base and deep customer ties. That's their core foundation.
It is. But, as you pointed out earlier, this legacy comes with two critical liabilities that the modern investor absolutely must factor in.
And the first one is structural. It relates to their core product mix.
That's the secular headwind. The company's historical focus on carbonated soft drinks, or CSDs, means they're still fighting against the diminishing sugar habit in the population.
Right. Despite massive diversification, they are still disproportionately reliant on those core soda brands for a huge chunk of their revenue.
Which requires constant, proactive portfolio management to introduce healthier and non-CSD alternatives into the system.
And the second liability is financial, and it's directly inherited from that 2025 buyout. The low debt legacy is officially over.
Correct. Consolidated now carries substantial pro forma debt. We're talking around $3 billion to finance that KO buyback.
So that shift from a near net cash position to a leverage ratio of 2.6 times debt to EBITDA, that is the most crucial pivot point in their financial strategy.
It is. Management now must prioritize debt service and reduction, which, it limits some of their future capital flexibility.
And we also have to touch on the company culture. It's explicitly mission-driven. They adhere to the principle of honoring God and community service. That generates employee loyalty, goodwill.
But for a purely return-focused investor, that translates to tangible costs.
Right. It creates a fascinating tension, doesn't it?
It does. While this culture fosters stability and a long-term vision, it also translates to mission-driven expenditures that might not be purely optimized for quarterly profit.
The source material notes $53 million in charitable contributions in 2024.
And for some investors, that's an admirable expense. For others, it's $53 million that wasn't used for an accelerated share buyback or to pay down that new debt faster. It's a key part of the governance reality here.
So the core framing question as we move into the recent operational deep dive is this. How effectively are their historical strengths, their scale, their market power, their operational efficiency, being leveraged to address these current challenges of shifting consumer tastes and servicing higher interest obligations?
We need to see disciplined execution right across the board.
Okay, so let's break down the revenue model. Let's use 2024 data. How are they making their money today?
Well, it's a distribution business, plain and simple. About 92% of that $6.9 billion in net sales comes from the sale of finished bottles and cans.
And within that, what's the current mix between, say, sparkling and still drinks?
So sparkling beverages, the core CSDs like Coke, Diet Coke, Sprite, are still the dominant category. They contributed $4.11 billion, or 59% of total sales.
Okay, so still the majority.
Still a majority. However, the growth engine is the still beverage segment. That's your water, energy drinks, tea, juice, which generated $2.3 billion, or 32%.
And the rest?
The remaining revenue comes from things like syrup sales and distribution fees.
Okay, so we know that CSD volume growth is stagnant or even slightly declining in the U.S., so that still segment is absolutely critical for their overall revenue growth.
It is. Even if sparkling retains slightly higher gross margins, the key growth drivers are non-carbonated, especially the energy drink category, which is anchored by partners like Monster and hydration products like Body Armor and Powerade.
So management is pretty adept at using that volume decline in CSDs as an opportunity to push higher value, higher growth products through their massive distribution network.
Very adept. And there's also a subtle shift in their distribution strategy we should highlight concerning fountain syrup.
Right. The revenue from post-mix syrup is actually declining.
It is, but this isn't a bad sign. It's a strategic move. The company is actively shifting away from physically delivering low-margin fountain syrup in those big bags or containers.
To a distribution fee model.
Exactly. By leveraging KO's existing third-party infrastructure for this lower-margin, high-volume delivery, Consolidated improved its overall operational cost efficiency and can focus its own assets on higher-value finished goods delivery. It's a smart move.
It makes a lot of sense. Now let's talk market position. This is a mature business in a mature, consolidated industry. What defines the competitive landscape for them?
It's a stable, local oligopoly. You basically have the Coke system and you have the Pepsi system.
And the barriers to entry are practically insurmountable.
They really are. First, you have the franchise exclusivity. You simply cannot sell Coca-Cola products without Coke's permission in their territory. And then you have the sheer capital intensity.
Right. Building 11 production facilities and 60 state-of-the-art distribution centers is cost prohibitive for any new challenger.
Absolutely. So that makes their moat extremely wide.
Let's characterize that moat. What is the actual legal foundation that protects this regional near monopoly?
Well, the foundation is twofold. First, you have the brand power of Coca-Cola itself, which creates the consumer demand. Sure.
Second, and this is absolutely crucial for an investor to understand, is the legal structural moat provided by the Soft Drink Interbrand Competition Act of 1980.
We mentioned this earlier, but let's flesh out what that actually means for them.
This federal law specifically grants soft drink manufacturers the right to grant exclusive territorial franchises to their bottlers.
As long as there's other competition in the market, like Pepsi.
As long as there is substantial and effective competition. Exactly. For Coke, this act provides legal protection against any other company, or even KO itself, trying to sell Coke products in their designated geography.
So it makes their territory a near monopoly for the entire Coca-Cola portfolio.
It does. And that provides incredible revenue predictability and defense against any price erosion from internal competitors.
What about the retailers? What are their switching costs?
Extremely high. I mean, think about it. A retailer, whether it's a small gas station or a massive Walmart, cannot simply stop carrying Coca-Cola products without losing significant consumer traffic and sales volume.
It's just not an option for them. It's not. And Coke uses that consumer pull and its dominant scale to create very high switching barriers, which further insulates their revenue base. They have the lowest cost to serve in their region because of their scale, which just reinforces their position as the unbeatable incumbent.
Let's put some numbers on that. The U.S. non-alcoholic beverage TAM, the total addressable market, is huge. It's nearing $300 billion. How much of that pie does Coke actually control in its region?
So if we estimate the retail value of the products they sell in their 14-state area, their serviceable available market, or SAM, is roughly $40 to $50 billion.
Yeah.
Coke's $6.9 billion in net sales translates to maybe $10 billion in retail value. So this suggests they command approximately 20 to 25% of the total non-alcoholic beverage market in their regions.
And for CSDs specifically, it's much higher.
Often more than one-third of the CSD volume. It's a formidable market share.
But the flip side of that scale is the risk of customer concentration. This is something we see across so many large distribution businesses.
It is the Achilles heel of any major distributor. The source material shows two customers, Walmart at 17% of sales and Kroger at 12% of sales.
So together, they account for 29% of Coke's 2024 net sales. Wow.
Almost a third of the business.
So why does this concentration matter for long-term value creation and investor returns?
It matters because large buyers leverage that concentration for bargaining power. If nearly 30% of your sales walk out the door, it's catastrophic.
So Walmart and Kroger can demand highly favorable pricing, steep promotional terms,
and specific service-level agreements that constantly threaten margin compression. It means Consolidated has to continuously execute superior service, high fill rates, perfect on-time delivery, effective merchandising, just to maintain those relationships and mitigate that giant buyer bargaining power.
So it's a constant low-grade warfare over every single margin dollar.
It is, which is why the quality of their operational execution is so important. It's what separates Coke from just being an average distribution company. And recent performance suggests they are executing at a very, very high level.
Okay, let's focus on the most recent data. Q3 2025. What were the key takeaways from that quarter?
The Q3 2025 highlights were strong. Net sales were up 6.9% year over year. That was driven by a combination of volume growth at 3.3% and effective pricing.
And the operating margin hits 13.1%. That's pretty healthy.
It is. And importantly, the still beverage sales led the growth, up almost 10% year over year, which confirms their strategy to capture those high growth categories is really working.
And the expansion of the gross margin is key. You said it's moving toward that 40% threshold. How did they achieve that improvement, especially with commodity headwinds?
This is the core success story of their operations. Gross margin ticked up to 39.6%. And that's primarily because management successfully implemented price increases estimated at about 5% in early 2024.
And that was enough to fully offset the headwinds.
It fully offset persistent commodity headwinds in aluminum, PET resin, and sweeteners. This shows genuine pricing power. It confirms that consumers and retailers view their products as essential, which allows them to pass those costs through.
And that kind of execution earned them the Bottler of the Year recognition in 2025. Let's dive into the unit economics. We have the average numbers, but we need to understand the cost structure a little better.
Okay, let's use the 2024 data again. They sold 353.1 million equivalent cases. On average, net sales per physical case were $19.53.
And then after all the costs.
After cost of goods sold, which is high because they're buying raw materials and paying for the concentrate, and after the significant selling, distribution, and administrative costs SD&A, the operating profit per case was approximately $2.61.
So that 261 figure is the reward for all that incredible logistical complexity. How is their cost control structure defined?
SD&A is the largest variable operational cost. In 2024, they managed that SD&A expense tightly at 26.6% of net sales.
The scale benefits must be massive there.
Huge. Every single route optimization, every efficiency gain in the warehouse directly lowers that SD&A percentage. They are getting real leverage on their fixed distribution network.
And we also need to remember that profitability varies a lot by product line.
Oh, yes. Sparkling CSDs, though they're slower growing, generally have higher gross margins than, say, bottled water.
But the profitable shift is toward high-value distribution.
Right. Products like Monster Energy, even though they involve paying a distribution commission back to the brand owner, are high value and high velocity. They boost the overall profitability of the still segment and improve the average unit economics.
Let's look at the customer side again, but frame it with the LTV-CAC relationship. For a major account like a regional Kroger distribution center, how should we think about lifetime value?
For a major retailer, the relationship is effectively an annuity. The customer acquisition cost, or CAC, is minimal. It's the cost of the sales team's time, maybe some initial promotional support, or a loaned cooler.
But the lifetime value, the LTV, is essentially infinite.
It is, provided the retailer stays in business and their franchise rights hold. It's an irreplaceable, long-duration asset for them.
And what about the capital efficiency of their smaller growth investments, like putting a vending machine into a new office building?
Even those micro-investments are highly efficient. If they invest capital in a lone vending machine, that machine becomes a dedicated, profitable sales channel.
And the payback is quick.
Hypothetically, if a machine costs $3,000 and the product sells at a 50% gross margin, the payback period on that capital is often under 2 years. It just confirms the high capital efficiency of their core asset base.
And their sales strategy, it's focused on maximizing same customer sales growth, cross-selling their whole portfolio.
Exactly. We mentioned earlier that the operating margin has expanded significantly. This shows up clearly in their capital efficiency KPIs.
That 300 basis point improvement over the last 5 years.
Right. The operating margin has gone from the 8-10% range to 13% now. That sustained improvement in a mature industry is a powerful validation of their efficiency strategy, their ability to integrate those refranchised territories seamlessly, and their pricing discipline.
And that operational excellence translates directly into powerful cash generation.
It absolutely does. The company generated $722 million in operating cash flow in just the first 9 months of 2025 alone,
Wow. And that massively exceeds their maintenance capital expenditure.
which is roughly $210 million per year. So this demonstrates a robust free cash flow generating capability and confirms a high return on invested capital, or ROIC,
Likely in the mid-teens or higher.
which is well above their cost of capital, proving genuine value creation.
They also utilize high-tech operational platforms. We should probably explain one of the key systems mentioned in the source material, the CoNA digital platform.
Brett CoNA. It stands for Coke One North America. This is the standardized digital platform that's used across the entire North American Coke bottling system.
So it's not just an IT system, it's more than that.
It's a unified business process platform. It covers everything from seamless inventory management and order processing to route scheduling and financial reporting.
So by using CoNA, Consolidated reduces complexity, accelerates data flow, and ensures real-time optimization across their whole network.
All 11 plants and 60 distribution centers. It gives them a necessary edge in speed and accuracy.
Okay, let's delve deeper into the financials, starting with that margin expansion. We noted the 300 basis point improvement in operating margin over 5 years, pushing gross margin towards 40%. Why is this trend so sustained in a historically tight margin business?
Well, we attribute it to pricing power and mix shift, but there's a structural reason as well related to the refranchising.
Right. You mentioned that. Can you detail that structural shift further? How did refranchising actually help their margins?
This is a crucial detail. Prior to refranchising, the bottler often bore many of the marketing and promotional costs associated with the brands.
Okay.
When KO took back the burden of ownership, they established a new agreement. The bottler now pays a fee to the Coca-Cola Company, but KO takes back most of the heavy lifting and financial responsibility for all the national advertising and marketing campaigns.
So, Consolidated effectively trades these variable, unpredictable marketing costs for a fixed, predictable fee.
Exactly. And that shift in the cost structure provides greater margin stability for Consolidated. It allows their operating margins to expand and remain sticky at these higher levels. It demonstrates the business model transformation was accretive not just to revenue, but fundamentally to profitability.
Let's discuss how this strong cash flow is being allocated, because management has certainly changed its strategy recently.
Yeah, they have. For years, cash was allocated to territory acquisitions, but since the U.S. refranchising is largely complete, M&A opportunities are scarce.
So they pivoted.
They pivoted to distribution and returns. They paid a large $18 per share special dividend in late 2023, and that was followed by the massive KO share buyback in 2025.
Which is a rational allocation strategy.
It is. It signals they have more cash than necessary internal growth opportunities, so making a cash return is the most effective way to enhance shareholder value.
Now for the elephant in the room, the increased leverage. The post-KO buyout balance sheet looks very, very different.
It really does. Pro forma total debt is approximately $3 billion now, up substantially. The key metric to watch here is the debt-to-EBITDA ratio, which is now at a moderate 2.6 times.
Okay, so for listeners who are focused on stability, 2.6 times might sound high for a historically conservative company. How should we stress test that figure?
You assess it against the stability and the predictability of the cash flows. Coke's revenues are non-cyclical. I mean, people drink Coke regardless of a recession.
True.
So their interest coverage ratio EBITDA divided by interest expense is still very strong. It's sitting between 7 and 8 times. This indicates an extremely low risk of default.
And they have liquidity.
They maintain strong liquidity with a $500 million undrawn revolving credit facility. Management is financially disciplined, and the inference here is that they will use their robust cash flows to prioritize debt reduction.
So the target is probably to get back to that historically conservative 1.5 to 2 times leverage target.
I would think so, yes. Likely within the next 2 years.
Let's turn to valuation. The stock hit an all-time high of about $163 post-split in late 2025. Is the market getting ahead of itself here, or is this justified?
I'd say the market is appropriately pricing its quality and predictability. The valuation multiples are high relative to Coke's historical averages, I'll grant that.
What are we talking about?
The forward price to earnings, or PE, is estimated around 15.5 times, and the enterprise value to EBITDA is around 12.6 times.
Okay, let's unpack this. Why the high valuation then?
It reflects the market finally recognizing the improved quality of the business post-refranchising. They have better margins, a wider moat, and reduced reliance on CapEx for growth.
And how does it look compared to peers?
Well, when we compare them to the closest high-quality peer, Coca-Cola Euro-Pacific Partners, or CCEP, which trades around 16 times earnings, Consolidated's valuation is comparable.
So it's fairly valued. It's not a deep bargain, but it's justified.
It's justified by the defensiveness of the asset, the consistency of the cash flow, and management's effective capital allocation, especially that EPS accretion from the KO buyout, which, by the way, happened at a discount to the market price.
A large part of this investment thesis relies on the people running the show. So let's put a score on the management team, starting with their competence.
Overall, management is rated strong. CEO J. Frank Harrison III has led since 1996, which is remarkable longevity and vision.
His tenure has overseen consistent value creation, something like 15% EPS CAGR over the last decade.
That's right. And he successfully navigated that transformative refranchising era. So operational execution, as evidenced by the margin improvement and customer service levels, is also rated strong.
But the financial score takes a slight hit.
Yes, financial management is rated fair. And this is entirely due to the recent material increase in leverage to fund those repurchases. It's testing their long-term financial conservatism.
So while the move was strategic and accretive, it introduces a necessary watch point for debt management going forward.
Exactly. But alignment, however, remains absolute.
Right. The Harrison family controls 100% of the Class B voting power. Their wealth is intrinsically tied to the long-term health of the stock.
And that high insider ownership aligns management with long-term shareholder interests and provides stability, insulating the company from any short-term market noise.
But that high control brings us directly to the governance concerns and the red flags for minority investors.
The primary red flag is the dual-class stock structure and the combined CEO and chairman role held by Harrison III.
Which concentrates strategic and operational control, essentially limiting the minority investor voice.
It does. And furthermore, stakeholder communication is rated only fair.
Why only fair? What information is lost when a company the size of Coke doesn't hold public earnings calls?
Well, the absence of public earnings calls means analysts and investors cannot directly interact with management. They can't question strategic decisions or probe into quarterly performance nuances in real time.
So while their SEC filings are robust and transparent, the lack of a live Q&A session limits direct analyst insights.
It forces the market to rely solely on scripted filings, so investors must be comfortable that they are investing in the long-term stewardship of the Harrison family, trusting their track record over the ability to demand quarterly accountability.
Let's pivot to the external risks, starting with supplier concentration, a risk we categorized as extreme.
It is the ultimate dependency risk. Consolidated is completely 100% reliant on the Coca-Cola Company for concentrate, for brands, for marketing support, and for product innovation.
So if that relationship soured, or if KO's brand portfolio suddenly faltered, Consolidated would be disproportionately affected.
It would. However, the current franchise agreement is locked in until the 2030s, which mitigates any short-term, arbitrary, strategic changes from KO.
And the high customer concentration risk, that 29% of sales from Walmart and Kroger.
Yeah.
How do they manage that day to day?
They manage it with superior execution. They just have to be the most efficient, reliable, and service-oriented partner. If they fail on delivery times or fill rates, those giants will leverage that concentration to push for further margin concessions.
So it requires constant vigilance. The fact that they were recognized as Bottler of the Year suggests they're currently winning that battle.
They are.
What about commodity exposure?
Commodity costs, aluminum, resin for plastic bottles, sweeteners are a high inherent risk. We calculated that a 10% jump in key inputs would raise annual costs by approximately $66 million if it wasn't fully hedged or passed through to the consumer via pricing.
So that requires continuous monitoring of their hedging strategies and, critically, their pricing power.
Right. In terms of a forensic review, it is largely clean. Management provides adjusted EPS figures to strip out non-cash swings, which is a transparent practice that helps analyst clarity.
And they've resolved minor legal settlements pretty quickly.
Right, like a $3 million wage and overtime suit. It indicates they are actively resolving operational issues, not fighting pervasive systemic problems.
Finally, we have to acknowledge the vulnerability of leadership transition.
We do. J. Frank Harrison III is 70. And while the COO, Dave Katz, is being groomed and has been instrumental in operational execution, any leadership transition is inherently a potential vulnerability.
The good news, though, is that due to the governance structure, the Harrison family is expected to maintain controlling influence regardless of who holds the CEO title.
Which suggests continuity of that long-term strategic vision.
Okay, we've covered a century of adaptation, from early M&A turbulence to modern, data-driven optimization. To summarize, Coke seems to be a fundamentally solid defensive consumer staple with a wide, durable moat defined by franchise exclusivity and scale.
The heavy lifting of territory expansion is complete. The current focus is entirely on disciplined, profitable execution, efficient asset utilization, and maximizing cash flow extraction.
What really stands out to me is the combination of their scale and their management's confidence. The ability of the family to pivot their capital allocation strategy from growth via acquisition to disciplined cash returns through special dividends. And that massive EPS accretive KO share buyout, it suggests highly effective capital stewardship.
Especially within the constraints of a mature industry. So let's crystallize the key takeaways for the long-term investor.
Okay. First, moat resilience remains paramount. Consolidated operates with de facto regional exclusivity and scale, underpinned by that Soft Drink Interbrand Competition Act, which provides predictable, high-retention revenue streams and sustained pricing power.
Second, margin expansion is a validated strategy. The structural shift post-refranchising, coupled with effective pricing and mix shift toward high-margin energy and zero-sugar products, has significantly improved their operating margins. That 300 basis point expansion over 5 years, making their profitability much more robust than historical norms.
Third, the leverage trade-off is the current financial watch point. The KO share buyback was accretive, but it introduced higher leverage at 2.6 times debt to EBITDA. Management must successfully execute its debt reduction plan over the next 2 years to restore the company's traditional financial conservatism.
And fourth, the governance reality requires investor acceptance. You must be comfortable with the long-term stewardship of the Harrison family. Their track record of growing the pie and maintaining strategic stability justifies this trust, despite the lack of direct minority investor influence via that dual-class stock and the limited analyst interaction.
So overall, Coke is investable for those seeking stable, defensive cash flow, low fundamental business risk, and moderate total returns. We're probably looking at a high single-digit expectation, driven by EPS growth from repurchases and consistent operations, rather than massive volume expansion.
Which brings us to our final thought for you to consider. With the equity entanglement officially severed, Consolidated is now fully strategically independent of the Coca-Cola Company's board. The key question moving forward is whether this new autonomy allows Consolidated to deliver even greater operational efficiency and maximize shareholder value, or if the lack of direct oversight from KO's board introduces new, subtle strategic risks. The final verdict rests on execution. Can they maintain market share and pricing power in the face of ongoing consumer shifts while navigating the new demands of higher leverage? The historical pattern suggests prudent, adaptable management, which is the best defense in a mature, consolidated industry.